Japan is on fire. The country has two terrible problems and can only fix one of them. The first one is the yen. It fell to its weakest level against the dollar since 1986. Japan buys its oil and its food from abroad and pays in dollars. So a falling yen makes life at home more expensive every single month. The second one is the debt. Japan owes more than twice what its entire economy produces in a year, the heaviest load in the developed world. The medicine for one is poison for the other. Save the currency, wreck the government's finances. Protect the finances, watch the currency fall. So Tokyo tried a third route and went into the market to buy back its own money. He wiped out billions of dollars in just 48 hours. Washington even joined in. The last time these two countries bought yen together, Bill Clinton was in the White House. The yen shot up 5%. But a few days later, it was back where it started. Now, Japan is against the wall. If you think this is Japan's problem, you haven't looked at who lent the money. In this video, I'll show you what's breaking, how it could become the next global crisis, and how to protect yourself before it's too late. My name is Bertrand. I've been doing business in Asia for 26 years. That's why I created this channel, to share what I see from the inside. If that's useful to you, subscribe. Currency intervention sounds technical, but the mechanic behind it is simple. A currency has a price like anything else, set by how many people want to hold it. When Tokyo wants the yen up, it walks into the market with dollars and buys yen in bulk. The same way, a large buyer pushes up the price of a stock. But Japan doesn't keep that kind of cash sitting around. It holds assets. American government bonds, over $1 trillion of them, the biggest foreign pile on the planet. So the plan seems obvious. Sell the bonds, collect the dollars, buy the yen, currency goes back up. Simple? Well, not really. That is the exact scenario Washington cannot allow. When the largest foreign holder of American debt starts unloading it, the price of that debt falls and American interest rates rise. Mortgages, car loans, corporate borrowing, all of it takes its cue from those bonds. The US government already pays more to borrow than at any point since 2007, and it has roughly $40 trillion of debt to carry. Japan defending the yen on its own means the bill will land in Washington, which is why the Americans came in themselves. At first, you will think that America buying yen will mean selling dollars. That would be the obvious thing to do, right? Well, no, the Treasury refused because a cheaper dollar makes American debt more expensive to carry. So it sold euros out of its reserves instead. Tokyo pulled the same move from its side, borrowing dollars from the Federal Reserve and leaving its bonds there as collateral. Billions moved, and both governments went out of their way to avoid touching American debt. Japan ended up holding that much American debt for a reason, and the reason is the whole problem. After the bubble burst at the start of the 90s, prices in Japan stopped moving. Salaries froze for a generation. The Bank of Japan cut interest rates to zero and left them there for 30 years. Two things came out of that. Japanese savers earn nothing at home, so their pension funds and insurance companies ship the money overseas to anywhere that pay the yield. A country of savers turned into the largest foreign owner of American government debt. And the rest of the world worked out that Tokyo was handing out money for nothing. Borrow yen at zero, convert it, buy anything on the planet that pays more than that. American bonds at 4%, for example. Property in Sydney. Traders call it the carry trade. It was free money. Nobody knows how big it got because no regulator counts it. The Bank for International Settlements estimated the total at around $250 billion at the start of 2024 and said the real figure was probably even higher. Other estimates run into the trillions. The whole arrangement rests on one condition: the yen has to stay weak. You borrowed in yen and you repay in yen. While the yen falls, you earn back less than you took. The day rises, your loan grows while you sleep, your broker asks for more collateral, and you sell whatever sells fastest to cover it. This is what happened in the summer of 2024. The Bank of Japan raised interest rate by 0.25%. The yen jumped, and every fund holding those loans ran for the same door on the same morning. Tokyo dropped 12.4% in a single session, its worst day since Black Monday in 1987. Wall Street opened in the red, and the people watching their accounts fall had no idea Japan had anything to do with it. And that was just 0.25% increase. The Bank of Japan sits at 1% today, the highest since 1995, and the market is betting on another rise before the year is out. For 30 years, Japanese pension funds and life insurers had nowhere to put their money at home, so they bought long-dated government bonds across the developed world. Nobody in London or Washington ever thanked them for it. Their money just held everyone's borrowing costs down. But the party is over, Japanese bonds now pay something. The 30-year bond sits near 4% after a generation at almost zero. And once a Japanese insurer covers its currency risk, that beats what they can get in America. So the money is coming home. Japanese investors sold $29.6 billion of American debt in the first 3 months of this year alone. Government running deficits lost the customer who used to show up at every auction without being asked. They have to pay more to replace him. American 30-year borrowing costs are the highest since 2007, and the same picture repeats in London and across Europe. This is why Washington moved, not out of affection for Tokyo. The Japanese were about to speed up the one thing that was already making American debt more expensive. And this is where it stops being a story about a currency. Rising government borrowing costs set the price of everything else. Your mortgage, your business loan, what a company is worth, where the money goes. The bank that lent the world money for free is shutting its doors, and it is doing it while every major government on earth needs to borrow more than ever. Each country has its own explanation for it. In America, the deficit and the spending on artificial intelligence. In Britain, doubts about the government books. In Germany, the cost of rearmament. In France, politics. 4 countries, one lender working out on all of them at the same time. Tokyo and Washington can put billions of dollars on the table to shield themselves from this. Nobody else gets that option. Everyone below them takes the price they are given. It lands on the Japanese household first. Spending fell 3.3% in June when the forecast said it would rise. Wages have been climbing for 6 months, and people are still buying less, because a weak yen makes imported food and imported fuel cost more than the raise covers. And energy prices have made the problem worse. Ask the Japanese how the government is doing on prices, and 71% say it has failed. Then it crosses the water. The yen swung 5% in 3 sessions at the end of July, and the yen never moves alone. Japan, Korea, and Taiwan sell the same cars and the same chips to the same customers. Traders price the region as one block. Hong Kong gets a different version of the same bill. The Hong Kong dollar is pegged to the US dollar. So, a company there imports American interest rates without ever touching the yen. Which brings us to whoever is watching this video. Running a business means controlling what you can control. You choose your suppliers and your prices. Then a finance minister you have never met walks into a market in Tokyo, spends billions of dollars, and every price you agreed in Asia moves. Your margin for the quarter has been decided in a room you will never enter. Any business that sells in one currency and buys in another is making a bet. The professionals knew. The big funds have started moving away from the yen. They watched this all day, they saw it coming, closed out, and went home. But if you are an entrepreneur, you run a business, you don't have time to focus on this kind of things. So stop trying to guess the number. Take the number off the table. There is a contract designed to solve exactly that problem. It's called an FX forward. An FX forward lets you lock in today's exchange rate for a payment you'll make in the future, whether that's 30, 60, or 90 days from now. Imagine you owe a supplier 5 million yen in 3 months, but you only have USD. Instead of waiting to see what the USD-yen exchange rate will be on the day you pay, you agree on the exchange rate today. Whatever comes out of Tokyo between now and then is somebody else's problem. When payment is due, you pay using that agreed rate. Whether the yen has become more expensive or cheaper, your cost stays exactly as you planned. If the exchange rate moves against you, you're protected. But if it moves in your favor, you don't benefit either. You gave up the chance of a better price in exchange for certainty. That's the kind of service we offer to our customer at Statrys. If you are interested in it, I'll leave the link in the description. If it's too complicated, just add me on LinkedIn, I'll have my team explain it to you. The Bank of Japan meets again this autumn. Increase rates and the yen turns. Then everyone who borrowed cheap Japanese money finds out what their loan really cost. Do nothing, and the yen keeps sliding until Tokyo rolls back into the market with billions more dollars. Let's see what happens. If you've been burned on a rate before, put it in the comments. Those stories teach more than any chart I could show you. See you in the next video.